good evening. On behalf of the entire team at Edelweiss Mutual Fund, welcome to our annual house, and we hope that wherever you're watching this from, you and your families are safe and happy. As some of you know, we started our open house series at Edelweiss Mutual Fund last year. As an organization, transparency is very important to us, being open to our investors and partners about what we do, how we manage your hard-earned money, how our investment philosophy is shaping up, and how we've been managing your money is important. This is our second annual open house in this series. FY22 was a very special year for us, and it was not just a special year because of the kind of asset growth and investor growth we saw. It was a year where we have invested, no pun intended, in strengthening our investment team across each category today. At Edelweiss, we are driving an investment-first culture and a lot of innovation in product, something that you guys keep writing to us, our distributor and investor community. At the asset management level today, we are now a 22-member investment team, which includes CIOs, fund managers, analysts, and dealers. And today you'll get a chance to talk to many of them, interact with many of them, and we hope that you'll enjoy that interaction. For us, from a fund point of view, our focus has always been on delivering consistency in fund performance and placing utmost importance on risk management. Today, we are going to spend time talking about our core investment philosophy and how we manage money in each of the asset classes and funds. Many of you have seen the agenda, but some of the things that we will cover is our long-only funds, followed by our international funds, our hybrid funds, and fixed income funds. And of course, we are very excited to take all your questions, so keep them coming in. Another critical focus for us as a fund house will be evolving our investment approach around things like ESG. We'll talk about how we're driving ESG in our funds on the equity conversation. But as an organization also, we are committed to ESG in many different ways. And you'll keep hearing more about that and many initiatives in things like our annual report. Last year was also a special year for us because of the growth and awareness that we've seen in a category that's very close to our heart, and that is debt passives and target maturity funds. Started with Bharat Bond, and we are delighted to be a leader in that space. We've now built this basket of target maturity funds across various maturities to serve your needs, and we'll be having a conversation later today about everything that is happening in fixed income, the environment about interest rates, and of course, how you can use these target maturity funds to fulfill your fixed income goals. We are also committed to improving our digital properties and making it easier for you to both understand our funds and buy funds. So we've been working to build robust and strong digital platforms for both investors and partners. Of course, that's always work in progress. Some of you may know that we've recently launched our mobile app, eInvest for Investors. If you haven't checked it out, we absolutely encourage you to, and we welcome all the feedback that comes there. eInvest not just enables transactions, but is also a hub for the content that many of you like, including podcasts, book summaries. So please go check eInvest out. And finally, I think equipping our investors and partners with updated and interesting knowledge is an area that we've been focusing on for the last few years. We often get comments on book summaries and some of the initiatives we do, and we really welcome that. We've consistently been doing the Connect series in the form of webinars. We introduced Connect School to do live training sessions, and we've got some fantastic feedback on the training sessions we're doing. There's interaction that we're having with you on mediums like Twitter Spaces, where our fund managers and our leadership team has been present. And we look forward to engage both in the online and offline format. With that, let's get started with the open house. As I said, the format is well known. We'll have 4 sets of sections. We will take questions at the end of each section. So whether it's equity, hybrid, fixed income, or international, keep your questions coming in, and we promise to take all of them. If there are questions that we cannot take in the middle of the sections, then we will take those questions at the end, where the entire team will be present to take all your questions. So keep asking, and we're looking forward. Once again, on behalf of the entire team at Edelweiss Mutual Fund, to all our investors and partners, thank you for your exceptional support in the last 1 year and over the last many years. And we look forward to what the coming year will bring. With that, what we'll do is I will invite our long-only equity team so that we can kick off the first section. Okay, welcome to our first session on equities, long-only equities. I'd like to start by introducing Tridib Bhattacharya, who is our CIO Equities, and his entire team is here. I won't introduce the team because I will ask Tridib to introduce the team. But we have lots of questions for the team, and we'll be taking your questions on long-only equities also at the end of the session, so keep them coming. Tridib, I'll start with the first question to you. So, 2 questions. Stock picking is, of course, both an art and science both. It'll be great if you can do 2 things. One is talk a little bit about how you blend this art and science in your investment philosophy, our investment philosophy, and the process we follow while picking businesses. Also, since we've expanded the equity team here, it will be great if you can start by explaining and introducing the team and explaining how the team is structured.
Thanks, Radhika, for your question. Good evening, everyone, and hope all of you can hear. And it's great to be, and I think open house session is a great session to sort of talk about the views that we have, how we orient ourselves, and B, also get some feedback or questions, so keep them coming. But going back to the question that Radhika asked, that the philosophy and the process, I must admit that at the heart of it, we all know that equities are volatile, and performance today is strong, tomorrow could be weak. But the key thing that we stand for is the investment philosophy and the process that we follow. That, in my opinion, is something that we want to build in as a fabric for not only for 1 year, 2 year, for a good time to come. And hence, this is the most important question to sort of start the session with. And allow me a latitude of about 4 or 5 minutes to take a bit of time to understand this, to tell you all about this, because it is important. It's important because this is what we do. This is what we want to stand for. And it's important that you appreciate, and we'll be more than happy to take questions on that. So we actually call our investment philosophy FAIR. And as we coined the term and as we thought about it, it's probably the fairest way of picking stocks in our opinion. So what does it really stand for? So 4 parts to it. F stands for forensics, A stands for acceptable price, I stands for ESG aware, and R stands for robustness. Now, on the face of it, that might look like slightly MBA-ish. Let me kind of put a thread around all of these to kind of make it clear what we really want to say here. So at Edelweiss MF, we are at the end of the day bottom-up stock pickers. So as bottom-up stock pickers, how do we kind of enhance our focus? How do we get to the right set of companies so that we can deliver consistent returns over a period of time for investors? This is what we do using FAIR. So to put it in the form of a necklace, I would say that we are interested in basically financially clean companies. And that's the forensics part. Second, that can grow sustainably. This is the ESG part. Third, we are interested in robust business models. Companies that are present in scalable opportunities, and management can take advantage of that, not only in terms of growth, but also profitability as well as return ratios. So not just growth, but profitability and return ratios are also important. And finally, as investors, they should be available to us at an acceptable price. So that's basically F.A.I.R, the investment philosophy that we stand for. And trust me, over the last 6-7 months that we have sort of articulated this more clearly, the performance and various different things that have followed. As you hear a lot of my colleagues talk about this, you will find that there is a bit of consistency that is coming around. A lot more to go, but that's as a starting point. So in order to do justice to the investment philosophy and process, one of the things that both myself and Radhika, we sat together and kind of was very clear to us that fund management should be a mix of fund management and sectoral expertise. It can't be just fund managers and analysts being separate. And that is basically the thinking process behind how we have structured our equities team, all of you that you see over here on the stage. So let me start with the leftmost person. His name is Sahil Shah. He's an old-timer at Edelweiss MF. He is the co-portfolio manager of Mid-Cap Fund, runs the Small Cap Fund for us, and also as far as sectoral expertise is concerned, his expertise lies in consumer discretionary and chemicals. Over 14 years of experience into equities and in the sectors that we talked about, apart from fund management. Let me kind of introduce then Abhishek Gupta, who recently joined us from Goldman Sachs Asset Management. Apart from being the fund manager for large and mid fund, his sectoral expertise spans almost more than a decade in industrials, IT sector, and a few other sectors as well. So fairly experienced person as much as you can get. And then let me come to the person on my right, Mehul Dalmia, who is probably the newest, not probably, is the newest member of our team. And this is a part of, it represents a part of analysis which I am particularly quite excited about, particularly given what we plan to do here. His focus is likely to be going forward on ESG, on forensics and quantitative analysis. We'll elaborate more on detail as we kind of talk along various different aspects of what we want to do in this. But let me tell you, the forensics is such an important part of our analysis. It's almost like a 1-0 tool in our investment philosophy. In other words, particularly for mid and small cap companies, which are two of our bigger funds, we find that if the companies don't match the forensics profile, in other words, are not financially clean, something that I described as part of our investment process, we actually don't invest in that. So that's how critical it is. That's how critical his role is. And the important thing that you see in this is all of them not only are fund managers, but also in some form analysts as well. Even I look at consumer staples and a couple of other sectors. So overall, we are all stock pickers. That's what we want to stand for. That's what our investment philosophy is all about. And hope over a period of time, as we speak to you in various different forums, this comes out loud and clear.
Thanks, Tradeep. So before I get to, and we'll spend time talking to the team as you've introduced them on specific funds and deep dive into funds. But maybe I could start with a more general question. For investors, I think your thoughts on current market events. Of course, it has been a first half of the year of volatility, and I know there was a year-end note we wrote to this effect. More than current market events, I think how we are playing various themes across the portfolio. And I think what also investors would be concerned about in these volatile times is which are the areas where you and the team are extra cautious while picking businesses?
Yep. That brings us to the current market conditions. But before we go there, I think in the answer to the last question, I covered basically in a nutshell what we do in the way we go about picking stocks. I wanted to spend, before I answer your question, in terms of what we don't do. That's also equally critical and will come out as a lot of us speak. The first thing that we don't do is basically take macro calls. Our portfolios are not really oriented around whether Modi will come on power or Yogi ji will come on power, but it's more oriented about how the bottom of earnings of the companies would stand to do. That's number one. Second, we don't take outside sector bets. And that's something that we have agreed as policy across all the portfolios, and hence we want to let our stock picking do the work. And third, we don't take cash calls. We believe that the distributors or the community that represents on the other side of the table today, they have taken a view based on which they have allocated money to us to manage. And we want to put it to work in the best possible way in the best possible companies that can generate returns. We don't want to second guess their portfolio allocation call as well. So that's something very important in terms of what we wanted to cover. Now let's come to the market view and the lay of the land. I would say that in a nutshell, India today, in the context of the last 10 years that have been for India, and India today in the global context, in both these circumstances, this is the best position that India has ever been. Let me first talk about India in the context of the last 10 years. In my opinion, there are three things which are happening in India which are particularly interesting to note. First of all, there is a good chance that we will see a private sector capex happening in India, something that has not happened in the last 10 years or even more. Second, we think we could well be in the first 2 years of bottoming out of the real estate cycle. Real estate, apart from just equity markets, is genuinely boon for the overall economy as it causes employment and various different good things that come along with it. And third, for all of you listening who are employed, for the first time in the last 15 years, we've seen salary hikes come through which are in double digits, something that we haven't seen in the last 15 years. Last 15 years has been more, single digits. So all in all put together, if I put together all of these three and look at it from the medium term or 2 to 3 year perspective, there are really 4 themes that we are quite bullish about and are well represented across our portfolios. So much so that as we all speak, hopefully that comes out. First of all, we are bullish on a rebound in credit growth. We think as the economy turns around, there will be a rebound in credit growth, and financials is a good way to go play this in our portfolios. Second, an even bigger call is basically our call on private capex cycle. We think that playing through industrials and allied sectors is a good way to leverage of the situation that we have in India, and the portfolio should stand to benefit from the same. Third, we are also positive on real estate and both direct plays as well as indirect plays like building materials and stuff like that. And finally, and actually quite importantly, in the context of last 10 years, for the first time we find that the government has struck a positive chord with the private sector. These have been in the form of PLI schemes. They have also been in the form of various other stands that the government has taken, maybe in the context of Russia, this, that, the other, which I think could be genuinely beneficial for some of our portfolio companies that we have handpicked in our portfolios as well. So those would be the themes, Radhika, that we would be kind of positive on. It has rub off on multiple sectors, but we think it's a good way to put together a bunch of bottom-up portfolios. That's what we think.
Thanks, Tradeep. I think what we'll do now is cover 4 of our funds in some level of detail. So Sahil, I'll start with you and I'll come to Edelweiss Small Cap Fund. Now that is one of the newer funds in the long only basket, but it's also completed a wonderful 3-year track record and a little more. So Sahil, can you tell us briefly about Edelweiss Small Cap Fund and talk also about what has contributed last year to the performance, and importantly, how is the portfolio positioned currently in terms of theme sectors?
Sure. Thank you for the question. So in terms of the objective of the fund or the philosophy of the fund, it is quite in sync with what Trideep also mentioned, that we look for companies which are expected to grow at a fast rate, companies which have a good corporate governance track record and do have a robust business model. So this quite aligns with our F.A.I.R framework, which Trideep also talked about. In the small cap space, what is more important is the forensics part, because apart from growth, it is the quality of earnings that also matters a lot. And it is all about how we filter out from the universe of small and mid caps, which is typically around 400 odd companies, to around 150 to 100 companies, which becomes our investable universe, from where we pick our and choose those stocks in the portfolio. So it is the quality of earnings that matter the most. In fact, if we look at the companies which have generated a lot of alpha or have been so-called multi-baggers, a lot of it has come from PE re-rating. And PE re-rating has happened primarily on the back of good quality of earnings growth and not alone growth of earnings. So that's what our core philosophy of the fund is. Now talking about which sectors have outperformed over last 1 year. For us, it has been IT, industrials, and auto parts have contributed to our returns. In terms of the themes that we like at the current stage, as Trideep also mentioned, China plus one theme is one of the themes that we believe has a growth which is going to continue for next 5 to 10 years. And I'll just spend a couple of minutes to explain on how we think about China plus one. In small and mid caps, you find a lot of companies in the chemical space. In fact, in 2015, the move from China to India had started to happen as China had banned a lot of polluting industries, including chemicals. In the ensuing years, the customers also wanted to diversify out of China, and that led to a lot of growth and a lot of capex in the chemical companies in India. Chemicals was always the forte for Indian companies, specialty chemicals. There were a lot of capabilities in the Indian context, and hence when customers started looking out of China, a lot of business came to India, and it is still coming to India. So if I look at the global chemical market, it is around $800 billion, out of which around 4% is captured by India, almost 15% is captured by China, or even more by China. So a small swing which comes out of China results into a massive earnings growth for the Indian companies. Also, the other theme that where we find a lot of opportunities, long-term opportunities in the small and mid-cap space is consumer discretionary, where we have companies which starts from automobiles, auto parts, to air conditioners, to washing machines, to apparels, and the quasi-consumer companies which are into the building material space. So in fact, if we look at the penetration of ACs in India, it is at a very, very low level. China sells almost 6-7 times more air conditioners than India does. In building material space, for emerging segments like MDF, which is a replacement of wood, China sells 15 times more MDF than India. So there is a long runway for such kind of businesses, and these businesses are a part of the small cap space.
Thanks, Sahil. Tradeep, I'll come to you on the next fund. Sahil gave us, a quick overview both of how last year looked for small cap. He talked about China plus one, especially in the context of going forward positioning. If you could move to Flexi Cap Fund, which is of course a fund that has the mandate to move across market caps, and give us a brief take on both the last year and the road ahead for Edelweiss Flexi Cap Fund.
Yeah, I think particularly in mid and small cap, the way we played the chemicals theme and the way we played some of the consumer discretionary themes have been really good for us, and we have some picks even going forward which look quite good. On the flexi cap context, at the end of the day, all the funds which are ultimately in some form or the other is fair at work. So we have this investment philosophy, which is not just a philosophy to sit there. It's kind of ultimately applied in different market cap ranges, which is and concoction of those stocks is what you see in the individual portfolios, right? In mid and small cap is what you see relevant to the mid and small cap area. But similarly, in the context of flexi cap fund, this fund has the flexibility to play across market caps and not get constrained or not get bothered about where majority of the opportunity lies. In many ways, it maximizes the opportunity that exists across market cap ranges. So there are many things to sort of cover in terms of how the sectors that have done well for us. I think couple of things that I wanted to highlight here, which we are playing through in this fund, is number one, the rebound in credit growth. Sometime towards the back half of last year, we realized that overall the corporate deleveraging cycle in India is really in the final stages. And hence, in that context, the last time this happened was in 2004, 2005, when banks subsequently saw a massive re-leveraging cycle and did quite well over a period of time. Not just banks, a couple of other sectors as well, but banks as well. We picked on that, and basically based on that, that changed our portfolio positioning with regards to on the financial side, particularly on the lending financials. So since then, while credit growth in India was at the bottom, lurking around 5 to 6%, it has subsequently moved to 8 to 9% as of the data that came about, or 10% as of the data that came about day before. And we think there is meaningful room for further expansion over the next 1 to 2 years. So a good part of our call, or a good part of our portfolio is reflected in, particularly in Flexi Cap Fund, in the form of overweight lending financials. And I think so far we have reaped some benefit of it, but we think that there is more to go over a period of time. The second area that I would highlight is basically household capex, or something that I covered as a theme earlier that we are positive on with regards to bottoming out of real estate sector. Now, if you really look at it, the real estate sector is a tiny bit in the benchmark, with only a few developers coming through. But if you look at it from an indirect play standpoint, we have quite a few portfolio holdings which cater to the real estate sector in an indirect way. So in many ways, if you think about real estate developers as hairstyles, we've picked some barbers in our portfolios, which benefit depending on whichever real estate developer wins. The barbers, in a sense, people who service these companies or these real estate developers would stand to do well. So building materials, tiles, and these are some of the areas that we are particularly positive on and well reflected in the Flexi Cap portfolio from a forward-looking standpoint. Hopefully, in the next 2 to 3 years, as they show their merit, that results in better returns.
Thanks, Trideep. Abhishek, I'll move to you on our next fund, popular fund. This is Edelweiss Large and Mid-Cap Fund. Again, if you could tell us briefly about the fund and its mandate, talk about what contributed to performance last year, and most importantly, how is the position going? How is the fund positioned going forward in terms of themes and sectors?
Thanks, Radhika, for the question. I think to start with, I'll touch upon what is the investment objective with which we are working in this fund. So the aim is to create long-term capital appreciation, which is going to focus on a risk-adjusted return basis, focusing on diversification, which is the key mandate. But given the nature of the fund, we like to focus our ownership towards large and mid-cap, because we truly believe in being true to the ideology with which we are working with. Now, before I move on to what we own and what we don't own, I'd also like to re-emphasize the aspect of the investment process that we run, right? So Pradeep did highlight that FAIR is the backbone of our investment philosophy. And I mean, I cannot emphasize more on that. Clearly, we live by that. Also, the fact that we believe or we trust our ability to assess businesses from a fundamental perspective. And what does it lead to is helps us from the perspective of creating a portfolio, which has the benefit of both diversification as well as finding the right fit for the portfolio, and hence creating a more holistic approach towards portfolio creation. I think what is relevant to focus here on is that it's an investment process driven selection when it comes to the stocks. And how does it help is it not only reduces the subjectivity which one would have without running on a process, but also helps us in orienting us construct of the portfolio, which is more kind of focused towards the fundamental aspect. So clearly it kind of takes away the individual subjectivity to a great extent. Now coming to how we kind of structure our fund right now and what we own. So clearly, I think one of the key aspects which is seen a theme across our portfolio ownership is the domestic capex recovery theme, which we are kind of trusting on. And there are various subparts to it. So let me touch upon a few of the aspects which we like there. The first aspect is clearly what we are hearing is that whole data center related capex which we're hearing. The fact that the government is emphasizing on those aspects, wants more localization aspects. Now, there's a good data point to start with. I mean, if you look at the number of mobile subscribers which are there in India, and I just kind of use Europe as an example to compare and contrast, we are almost 2x of the overall Europe as a continent, the mobile subscription base in India. But when you talk about the data centers which are available, which is also a backbone for that, you're barely at 10% of the European data center numbers, right? So clearly what I'm alluding to is that there is so much of room to spend in that space. And clearly, just going by the latest numbers which are available, you're talking about almost $14 billion of capex which already being committed in that aspect. So that's one theme which we like right now. The other theme which clearly I think is the talk of the town is this PLI-linked incentive-based schemes. Now, again, there are numbers which are still coming out. These schemes are still getting rolled out. But the last updated data which we have suggests that we're talking about possibly a $50 billion cumulative capex which will be spent over the next 5 years. And this capex will not only help in job creation, because we are possibly looking at upwards of 35 lakhs in terms of the overall job creation opportunity which will play out with this capex which is linked, but also talking about possibly annualized revenue run rate of about $100 billion per annum to be added because of the PLI schemes. And this clearly sets the tone that when we're looking at just not only India, but also a good global sourcing hub, PLI takes a very strong center stage to that aspect. Lastly, the private investment, which also is something which has been lagging for a while. But the good news here is that we have seen, if you look in terms of the overall capex commitments or the private capex needs, it's already double of what you have seen prior to COVID. I'm not even using COVID as an example because obviously those were disruptions which were in no one's control. Another aspect here is that within the private capex, the manufacturing and subsectors like chemicals, steel, and numerous sectors, they're talking about investments which are tune of anywhere between 3 to 5x. So that's clearly another theme where the private capex returns is something which we're liking. And lastly, but clearly another aspect which needs to be focused here is the whole industrial automation piece. We all are talking about IoT 4.0, we're talking about 5G, we're talking about benefits of that coming from the manufacturing process. But then there are few companies which have got technology to enable that aspect. And again, that's another area which we are liking. We all have talked about what we like, what we don't, but I think it's also worth mentioning there is another aspect. It's something like technology. That's a space where we have been bullish for a while. But to be fair, recently, we have turned a little bit cautious on that. I thought it's worth highlighting here, then again, the aspect which was earlier alluded to by Pradeep, that you're seeing a strong wage, the strong benefit of that, also has a negative rub-off of an IT, because ultimately these companies are kind of finding it hard not only to take care of the attrition rate and take care of delivery, but also there is a risk in terms of how you manage your profitability. So that's one space where we incrementally turn a little cautious, and that's how broadly the structure of the fund is right now, Radhika.
Thanks, Abhishek. And we'll come to the last fund that we are covering here, which is the largest fund in the long-only space. That's Edelweiss Mid Cap Fund, and this one has a long track record. So, Tradeep, if you can talk about the mid and small cap space again, what has contributed to the performance of this fund, and how we are looking at positioning going forward?
Sure. I think I think mid cap as a category, if you look at emerging markets and wealth creation that happens in emerging markets over a long period of time, which is 10, 15 years, not just 1 or 2 years, I think the wealth creation is something that happens in these two categories more often than otherwise. Now the fact is, in the mid cap categories, you have companies who have evolved from being small cap to slightly ahead of the curve with regards to have seen some scent of success, if I may use that word. And they are now basically in a rip-roaring phase where hopefully the growth takes over the next 4 or 5 years before they become the large cap. So in many ways, the mid and small cap are a good catchment area for investors who are looking to kind of, looking for alpha creation over a long period of time, over the next 5 to 10 years. And I think, knock on wood, so far, we have been able to do justice to that category overall. In the small cap, in the small and the mid cap, one of the unique things that we have is basically being true to label, and it's worth highlighting here. Unlike other places where kind of, where the large cap component could be higher or this, that, the other, we have decided to focus on, when we say mid cap, we mean mid cap. So, that's one thing that has kind of helped us being true to level in terms of holding our performance through the cycles. Now, going further a little deeper with regards to the areas that we are positive on that has contributed and going forward, I think in one of the big things that we are positive on the mid cap side is of course the chemical sector where Sahil covered the same. But one of the things that has really held us well in good stead over the last 2 or 3 years has been a play on the government growth scheme. Now, obviously I can't take the name here, but just to put a bit of context, about a couple of years ago, if someone were to set up shop in India, did you know that the tax rate that someone had to do that, for someone to do that was as high as about somewhere between 30 and 35%. Whereas if the same company were to set up shop in, let's say, Thailand, Indonesia, or some of the other emerging parts of Asia, that would have been about 15 to 20%. What a big difference. Now, a couple of years ago, this was changed, and incremental capacity could come in India at tax rate of about 15% or so. This was the first big change which actually kind of augured quite well. Just give me 1 second. There you go. That actually rubbed off quite well for the corporate sector. Subsequent to that, when the government actually announced the PLI schemes cut across multiple sectors, there was one which kind of did, outsourced manufacturing for quite a few customers, and that really took off over the last couple of years. Growth rates in north of 100%, and has a long tailwind of growth going forward as well. So as I said, mid-cap and small cap, mid-cap in particular or small cap, is a hotbed of bottom-up stories. So this was one story, or there are a couple of stories that we have played on this side, which have played on, overall. One is the PLI scheme, which I gave an example about. The other example that I could talk about was basically the so-called the importance of investment in defense. Over the last 2 years, one of the global things that have been happening, which we caught on slightly early, was basically you are seeing more and more nationalistic governments coming through in various different parts of the world. And as a result of that, the defense budgets of various different countries have gone up. And you might have noticed that the domestic component of that has been increasing over a while as well. So we hooked on to this trend a little earlier, and we capitalized on this through a few of our holdings, and have benefited nicely from the same. So I could go on and on. At the end of the day, the mid-cap fund is not a thematic fund. It's ultimately it's full of bottom-up stories like 2 that I mentioned, and there are many more that we can kind of talk about. But I'll leave it at 2, and hopefully we can flow on.
Terrific, and actually there are so many questions I would have, and I think the audience questions are coming in. If we have time, it'll be great to cover more of the stories that you, Sahil, and Abhishek all alluded to. But Pradeep, the last question I want to take from you is about the evolution of the investment process. Now, I think one thing that's very important for investors to know is that while there is an investment process, we constantly have to get better at what we do. New business models come to market, the environment around us changes. So our investment process is not static, it has to constantly evolve. Can you talk about how you guys want to evolve the investment process in the future? And some of this is, guys, work in progress. So I think we don't have all answers, but it's also important to tell you about the spaces and areas that we are exploring. So Tradeep, if you could just touch on the evolution of the existing investment process in the future, especially on forensics and ESG, which you touched upon in the F.A.I.R framework, and what the plans ahead are.
Thanks, Radhika. This is part of the process which I am particularly excited about. And I'm excited about because it is very important, particularly in the context of research in emerging markets. And I mean, I'm not trying to kind of, mince words here. Having managed money in developed markets and emerging markets, one of the big things, particularly because of our larger funds and mid and small cap, one of the important areas that we focused on, which Sahil also touched upon, is forensics. Forensics is so important to us that it's a 1-0 tool in case, basically what it means is looking a company beyond the P&L, the balance sheet or the cash flow, and trying to take a holistic view with regards to various stakeholders and see where it comes out and whether it still stands the merit of investment or not. Now this as an area in general is a very evolving area in the context of India. So forensics as a stream is one such concept. The second concept is basically ESG, and the environmental aspect of the external cost in economic parlance is something that that is another thing that that's just about evolving overall. And third is the intertwining of fundamental and quant. So a bit of quantitative analysis with regards to sharpening our decision-making skills on the fundamental side. So with that background, we recently joined by Mehul, joins from Axis, about a couple of months ago now, overall. And we are shaping this part of the investment team, which is more forward-looking in nature. As Radhika mentioned, that overall, we don't claim to have all the answers. We will evolve over time. But I also want you to know that this is going to be an extremely important part of investment process, let's say 3, 4, 5 years in time. And we don't want to be late in that. We want to evolve probably ahead, at least in line. So with that, let me bring in maybe Mehul, if you want to talk about what are we planning to do on the ESG side and whatnot.
Thanks, Sudeep. So, ESG is at a very interesting and an important juncture today. When I look at both India or when I look internationally, we are seeing a lot of consolidation happening in the standards. We are seeing the world come up and question what does ESG mean and what does it, really stand for. And you're seeing a lot of regulatory, regulations changing in India. We are going to get BRSR reporting at the end of this FY. India has committed in the latest COP26, which is a UNFCCC convention, where we're going to get a net zero target by 2070, and investments are going to get mobilized in this space as we go forward. Again, ESG is a very broad spectrum and a broad term, and what we are trying to really do as a part of really integrating it into our investment process, really enhancing it. So we have come up with an ESG investment framework. And through that, we really want to evaluate companies above and beyond the financial metrics that have been traditionally used. So, and the main driving force behind our framework is going to be materiality, because we believe it is very, very important to link the realities with the the frameworks we are creating, because it's very easy to go on and on about different parameters which are there and create some benchmarks, some source cards, but it has to be linked to the realities, and that's the very, very important part of that whole process. And in the framework that we've come up, we are using both qualitative and quantitative parameters to evaluate each and every company. These are again specific to sectors and industries where we are looking at, because we realize that something like governance, which is the G of ESG, which is environment, social, and governance. Now, the G part is maybe very, very crucial for something like a bank. But maybe environment and social may not be just as relevant, right? Like if I'm looking at a manufacturing company, the environment, the social aspects come into play more. So we are creating a customized framework which is going to be acting up for every particular sector, and it will give us a more holistic picture around how that company stands out, except just the financial metrics that we already look at, and help us compare better and make a more informed decision. So with that, we really think that this can really add long-term value when we select companies and look just beyond the financial metrics. Thank you.
Thanks. I think great introduction. I would just say that of all the things that Mehul does, one is forensics, one is ESG, the third is quant. Forensics for us is a 1-0 tool, in the sense if we are not convinced, we don't move forward. ESG is more as an information tool. It's basically something that we want to be aware of as to where the company is in the context of the sector. Maybe rate the companies in the context of the sector, which quintile or quartile they fall in, and engage with the companies on a proactive basis to see how that can improve. It's not a 1-0 tool for us at this point in time. At the moment, it's more an awareness tool. Of course, we would like to be in companies where there is a focus in that. But our ultimately focus is to make money for our investors. So just wanted to kind of flag that off as Mehul talked about that. Radhika?
Thanks, Trideep. So I've got a bunch of investor questions. We're going to try and take some of them, and then if we can't take all of them, then we'll try and take them at the end of the session. So Trideep, the first question is, and anyone can answer these, but this is a market-related question. What factors can cause a Nifty PE derating from the current juncture? And can the peak of the interest rate cycle, and of course there's been a lot of noise about this, cause a minor correction in equities?
Very interesting question. And allow me a couple of minutes to answer. So basically, one of the things that in my opinion is happening in equity markets, which is worth absorbing and understanding, is this interest rate regime change. Over the last 10-15 years, we have been used to a situation where basically China was the workhorse of the world. It used to export deflation to the rest of the world. And hence, we were in a deflationary scenario and interest rates were
Hi,
coming
can you
down.
hear me?
Starting somewhere around the end of last year, or maybe the beginning of this
Super.
year, we have seen this change. And it has caused a bit of flutter in equity markets, certain components of equity markets which are maybe growth stocks more than that of others.
Okay, thank you.
But basically at the center of all of the epicenter of all of this is basically the interest rate regime change which is happening.
Okay.
So given that preamble, will the interest rate increase result in basically lowering
How's
of
that?
PE? The answer is yes. Over a period of time, when as
I
cash
can't. I
flows
can't.
get
I can't
discounted
hear
at a
you over the
slightly
noise of the
higher
person
rate,
speaking.
the valuations of that actually comes down. That's just how the mechanics work, and hence, kind of to that extent, we will see valuation PE multiples done that. Now, some data for you. Since the beginning of this year, the PE multiple of India has contracted already about 15%, and not just in India, but if you look at globally. So it's not that I'm kind of propounding something which is completely out of the world. It's really happening as we speak. And it will probably continue to happen till the time the market finds its level of the right interest rates, in the sense where the Fed hike may be globally, or in the context of India, where the market gets an understanding that this is where the interest rate hike will probably stop. That'll probably settle the PE derating process for good, and then we will start focusing on the earnings growth in that context. So yes, it is a bit of a, particularly for people who have been investors in the last decade, where what we have been used to is a scenario where PE expansion happens. I think over the next 2 to 3 years, you have to be mindful that the PEs might not expand. In fact, it might contract. And basically, we have to hang our hat on earnings upgrades. And that's what we plan to do.
Terrific. So I'm going to combine two questions into one, Tradeep. There's an advisor who wants to know a little bit more about the decision-making process as far as stock and sector selection in the team, and how as a combined research team plus fund management team we take decisions. There's also a related question because you talked about not taking skewed sectoral calls, and if that's not done, how do you generate alpha? So if I can combine these two questions.
One good thing about this question is one thing is very clear. Whatever we have spoken here in the last 45 odd minutes has gone to the other side. It is not just, which is great. So thanks for that question. So, we lock ourselves up once a week, basically, to discuss elaborately on sector views as well as stock views. And basically what comes out view is not just my view or Abhishek's view or Sahil's view, but what we as an aggregate are collecting data points from various parts of the market, put that in the form of an investment sort of conclusion, and then take a view on the sector and whatnot. Now, the sector view, when I said that we don't take active sector bets, the range that we do so is basically plus minus 5 in the context of the index, which is some latitude, not a huge lot, but there is some latitude towards taking a bit of sectoral skew. My experience over the last 25 years suggests that generally macro and sector bets, the net alpha over a period of 3 years is 0. What really works is if you've got the stock call right or not. As Warren Buffett said, if you've got the facts right, as it turns out to be, then you will get rewarded for that particular stock rather than the sector. So that's how we take the sectoral view. What we also do very religiously is for all the stocks that we have, and we have about 125 to 130 in our portfolio, we have our estimate of what we call as intrinsic value. Now, what tends to happen is when we look at all of these in conjunction, we find that sometimes the upside in some particular sector is looking reasonably high, and on the other side, it's basically low. So that is a good tool for us to really think about that whether there is an investment upside in a particular sector versus that of B. Usually, these two combined, put together, have been good lead indicators towards basically making sectoral calls for us. But as I give this answer, I want you to note that the answer for the sector calls also ultimately is coming from a bottom-up view rather than taking a top-down view with regards to one sector or the other.
Thanks, Tradeep. And I think I will take the last question. It's an interesting question, but I thought I would address it. So there's a partner who wants to know a little bit more about our organizational structure and the fact that we're actually going to be having 4 conversations with 4 different teams today, and why is it structured that way? Because it's a little unique as an AMC. So I think what we do at Edelweiss Mutual Fund is we build centers of capability and very focused capability. And what you see today are 4 capabilities. There is a deep long-only capability that relies on a FAIR process and bottom-up stock picking that is represented by the team you see here and is led by Tradeep. There is a fixed income capability that is led by Dhaval, and he will talk more about that. There is a capability around hybrid funds, and of course, Balanced Advantage Fund has been an extremely popular fund. And we do believe, by the way, that hybrid is a separate set of capabilities. The process is a lot more quantitatively driven. It has elements like special situations and arbitrage, as well as a blend of equity and fixed income. And finally, there is an international investing capability where we partner with some of the best fund managers in the world, and JP Morgan has been a fantastic partner, and you'll hear them in the next session. So what we do as a fund house is we find talented managers, we find talented teams, we build funds that are true to label, and we are very focused on capabilities. The other thing I would mention is that if you see each of these teams, they don't manage a monstrous number of funds. So the team here today manages about 5 funds. That number may be 6, it may be 7. It of course will grow over time. If you see the hybrid business, you'll see a similar number of funds. Fixed income is also very focused in what we want to do. So we want to be very, very focused in what we do, because ultimately, I think, as Trideep said, our responsibility is to make money and manage risk on your hard-earned money, running a fewer funds in each team and giving each capability sharp focus. Each of these funds go through an elaborate review process, that I'm also part of. So managing less, being very, very focused and building these areas of capability is extremely important to us. And that's how we built the business. And if there's another area of capability that we find, then we will do it. We also don't want to do things that we are not ready to do or that we are not experts at. So that is what we'll stay away from, which is why you've seen limited but hopefully impactful launches from us. So that's just a little color on the org structure. With that, we're actually out of time in this session. So I'm going to close this section. Thank Pradeep, Abhishek, Sahil, Mehul, and all of you for your questions. And now hand it over to our next session, which is on international investing. My colleague Niranjan Awasthi and our team from JP Morgan will be joining us for that.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.